The S&P Bombay Stock Exchange Sensitive Index surpassed the 80,000 mark for the first time.
Should one be investing in the markets at this level or not? Secondly, should one come via the lump sum method or the systematic method? And thirdly, should one be exiting the markets and booking profits right now or not? Hello everyone, this is Shalini Gera. Yesterday I was talking to a veteran in the aviation industry in India. He was talking to me about the meteoric rise of the markets to 80,000 levels and was asking me if the markets are expected to go up further on. I'm sure this would be a dilemma that a lot of you would be facing today. Through today's video, I aim to answer 3 questions. First of all, should one be investing in the markets at this level or not? Secondly, should one come via the lump sum method or the systematic method? And thirdly, should one be exiting the markets and booking profits right now or not? Let's first understand the meteoric rise of the markets to 80,000 levels and also whether the run is expected to continue or not. The markets have risen to these levels basis 3 key reasons. The first reason is the fundamentals of the economy. India's economic fundamentals are very strong at the moment. I'll pick up 3 indicators to emphasize upon this. The first indicator is the GDP growth rate of India. The Indian economy is growing at the rate of 7% at the moment. US economy is growing at the rate of 2.4%. Chinese economy is growing at the rate of 5%, and the world economy is growing at the rate of 3.2%. This suggests how India is one of the fastest growing economies in India at the moment. So strong that the FII investors don't have much of a choice to invest. They see India as an oasis, as a sweet spot in the entire world's economic growth. Our growth is so strong that while most of the central governments are telling their banks in order to increase their growth, increase their lending, ours is perhaps the only economy in the world where the government is telling the banks to slow down and to become very cautious in their lending. This is precisely why the clampdown on Paytm Payment Bank as well as digital onboarding by Kotak Bank has occurred. The second factor that I'm going to take is the CPI, or the Consumer Price Index, which indicates the inflation. India's inflation target is 4%, and right now India's CPI number is at 5%. This indicates how RBI has done a wonderful job in keeping the inflation level in check and is not allowing the inflation levels to go too much beyond what is estimated or what is targeted. CPI is another indicator which indicates the economic strength of a country. In fact, let me also emphasize what a tremendous job RBI has done over here in order to bring inflation from 8.5% to 5% now. The third factor that I want to emphasize is the PMI, or the Purchasing Managers Index. It indicates the strength of both the manufacturing activity as well as the services activity in an economy. PMI above 50 indicates expansionary activity and PMI below 50 indicates contraction in the activity. If you look at both the PMI in services as well as in manufacturing, it is above 50 and it is very much close to 60, which indicates how strong the confidence of a purchasing manager is in the services as well as the manufacturing activity going on in India. PMI activity in both services as well as manufacturing have stayed above 50 from 2022. And if you look at the PMI activity of India as compared to all of the emerging market peers, it is the highest. Take a look at the companies that have already set up base in India in order to manufacture. These include PSMC, Apple, Foxconn, Google, and Siemens. Also have a look at the companies which are looking at setting up their manufacturing bases in India. These are Tesla, Mondelez Group, Amazon, as well as Nestle. Think about how many jobs are these companies going to create once they set up their manufacturing bases in India. Let's move on to factors beyond the economic strength as well. All of us know that this was an election year, and in June 2024, we once again saw Modi government win a third term. Election years have always been favorable for the markets. Have a look at the average market returns from 1999 till 2019. In election years, on an average, Nifty has given a 20% return in the 6 months preceding the elections and a 14% return post the elections as well. Let's talk about why this is expected to happen in this year as well. In this year, since we've had a continuity of the government, we expect all of the reforms that the government had started in the previous financial years to continue in the coming years as well. This means that the reforms like production-linked incentive, the growth story on the infrastructure, as well as the focus on the renewable sources of energy are likely to continue. This means that all of the companies which belong to these sectors are likely to have increased corporate earnings due to higher order books as well as increased market prices. Something very interesting has happened in the past couple of years. India's weightage in the MSCI Emerging Market Index has gone up to 18%, which is going to lead to another $2.5 billion of additional inflows in the Indian equity markets by the next year, as global passive funds are going to restructure their portfolios in order to match the allocation of the index. So, key three takeaways: the Indian markets are expected to continue the bull run in the long term, as we have an election year with the continuity of the government. We also have FII inflows due to the increased weightage in the emerging market MSCI index. Also, the macroeconomic strength of the country indicates a very strong markets future for India. So coming back to the questions that we had started the video with, are markets expected to go up in the future? Should you enter into this kind of a market? The simple answer is yes, considering the various factors that we have talked about. Should you enter by the lump sum or the systematic method? It is always recommended to enter into a market in the systematic manner whenever there is a downward trajectory in the market, because you end up getting a lower point for every single transaction and your average goes down. However, in an upwards going market, it makes more sense to enter by the lump sum method, provided your financial goals are long-term in nature. Ensure that you divide this entire lump sum into two parts. A higher percentage has to go into equity. This could be 70%, 80%, 90% depending upon your risk appetite. And the second smaller portion has to go into hybrid. Utilize the smaller portion strategically in order to switch to equity whenever the market offers you a steep correction. Third question is, should you be booking profits or not? It is always recommended that you exit out of equity only when your financial goals are due. So if your financial goals are in the next 1 year, it is advisable to exit from the equity markets and look at parking into the hybrid category in order to book your profits as well as to preserve the profits at these levels. However, if you do not have any near-term financial goals, it is not recommended to come out of the equity levels, because you will be sitting at redeemed funds in your bank account at a 2.5%. You will also be looking at capital gain tax, brokerages, as well as security transaction tax. Also, you will be looking at a bigger question as to where to park these redemption proceeds. Do you have a better alternate as compared to equity for the long term? The answer probably is no. So this was today's school of thought on Sensex touching 80,000 levels. I hope and I do believe that this added value to your financial planning content. Why don't you tell me what you thought of this video? What is your feedback? And also let us know on what else you want us to talk about in our next school of thoughts. This is Shalini Gera signing off. Bye-bye.